Okay, Mr. Lee, how is spring projection for the Indonesia financial market in the fourth quarter amidst improving U.S. economic data and the Federal Reserve's decision to maintain the benchmark interest rate?
Okay, there are two parts of the question, the performance of the markets and the Fed decision. We've had a lot of volatility recently, especially in the month of October. And just at the start of November, the markets have bounced. Everything relies on the Fed. I think if we look at the data that the Fed looks at, their dual mandate, which is one is jobs and the second is inflation. Inflation is ticking up, but the Friday jobs data shows maybe some cooling. So compared to just a few weeks ago, the probability that the Fed would stay in terms of where the interest rates are, that probability has gone up. It's closer to 90%. So that's where the markets are pricing in. And the markets are rejoicing, reacting positively to the recent data prints. If we extrapolate that into Indonesia, we're already seeing the bounce. But markets have not gone back to the levels in September. So I think if we think that the Fed will continue to hold where the interest rates are, there's a good chance the fourth quarter will end up slightly higher from here. We'll hold on to these gains for sure.
Okay, so how's market expectation regarding the Bank Indonesia monetary policy response following the Federal Reserve decision and the increase in inflation in Indonesia in October?
The markets reacted, well, the surprise BI hike obviously was a surprise, and the markets started to pay attention. That's when we started to see bond yields rise in Indonesia relative to the US bond yields. So in hindsight, that was necessary to stabilize the currency because the rupiah exchange rate was approaching 16,000, and 16,000 may be a psychological sensitive level. BI has officially raised interest rates, but we also saw many other policy moves before the rate hike that indicated that monetary conditions needed to be tighter. Anyways, there was the SRBI issuance, and then before that, a lot of effort to repatriate US dollars into the economy. So clearly from the regulator's point of view, from BI's point of view, monetary conditions ideally should have been tighter relative to where the Fed has been taking interest rates. So they've hiked, and the probability of the Fed, of BI continuing to hike interest rates, that remains open this month.
So do you see the Bank of Indonesia's decisions is correct for now?
So I think the general general analysis would be that BI maybe was a little bit behind the curve in announcing a policy rate hike, but it did do a lot to already tighten monetary conditions, especially the SRBI. And every auction of the SRBI rate has gone higher. So that is another form of monetary tightening. That policy decision, those policy decisions have helped. But what the market reads is also the BI reverse repo level. And whilst we are going through a bounce in the markets, conditions are less stressful currently. The volatility in the markets will generally keep BI very open to thinking about one more rate hike this month. We're not out of the clear. BI, just like the Fed, will be trying to watch the incoming data, right, and trying to second guess whether the Fed still needs to hike in December. If the Fed doesn't need to hike, and if BI thinks the Fed doesn't need to hike, then that will lead their decision to just hold interest rates.
Okay, so how do you see our interest rates make big impact to our economy data?
So not just interest rate levels, but tightening liquidity is already seen in multiple places. For banks, the cost of funds has been rising. Time deposit rates for smaller banks has been rising throughout this year, even without a BI rate hike. So monetary conditions or liquidity conditions are tightening. That generally leads to slower loans growth, and we are seeing that in the data.
Okay, the Central Statistic Agency has recently released Indonesia GDP's data for the third quarter, showing slower economic growth below expectations. And how does this economic stability affect market participant and perception?
I think the recent third quarter GDP print, 4.9%, is not a major disappointment. Yeah, 4.9, 5%. That's a very small difference. But generally, if you look at key areas of the economy, be it consumption, especially low-end consumption, or if you look at commodities and exports, you would be expecting a slowdown. Also, government spending has been really slow throughout this year, not just in the third quarter. So no big surprises to me that we saw a bit of softening in the third quarter print. And I think what we have to be more concerned about is whether or not these same conditions will persist going forward.
Okay, in your opinion, is there a risk for potential outflow from the Indonesian financial market towards the end of the year?
We've already seen outflows. So year-to-date equities, we've seen outflows. Bonds in the last 3 months or so, you've seen outflows. All of this has, I suppose, needed to happen because the market is repricing. The US rates are higher. Indonesian rates for some time were not responding to that. So investors, foreign investors, have the opportunity to sell and then buy something else. That is in the name of a reset. And I think we have reset lower. Bond prices are lower, yields are higher, equity prices are lower, rupiah almost touched 16,000. So all of that is the reset. And sentiment in the last 3 or 4 days has changed to the positive. And it's helping some of the flows to come back. So at the right levels, I think there's a buyer for Indonesian assets, for rupiah assets. And that also means that at the right levels, you see inflows, and we're seeing that.
Okay. And then how about the Eastspring investment strategy as we approach the end of the year and enter a political year?
Our investment strategy across both fixed income and equities. So let me start with what we think about next year. Number one, we already know that interest rates should be higher for longer in the US. That means Indonesian interest rates generally should be higher. That will slow down growth. And then the GDP print that we talked about, you see signs of some slowdown, especially on the export side. And we are particularly concerned about household consumption, the low-end household consumption. There is still a very evident two-speed economy. The low end is suffering. There's a lack of government spending to assist the poor. Maybe it's coming through in the fourth quarter, but it's a little bit late in this for this year. So for the broad economy, I think we have those concerns. Interest rates are high. The economy is not in a particularly strong growth momentum at the moment. And then next year we have elections and the change of government that will really complete the whole process by October inauguration. So we think that there will be some policy inaction and some businesses may stay on the sidelines. I think a lot of these I refer to are headwinds. And what it means for investment strategy is that we have, through this year, moved to a more defensive strategy. What that means from an asset allocation perspective is we prefer bonds. Yields are higher. So it's easier to think about buying the higher yields and staying invested there to collect the coupons. And over time, you get less volatility through bonds. So that's asset allocation, preferring bonds. On the equity side, we can characterize that as defensive. but defensive based on a few qualities. First of all would be thinking about higher interest rates, what it means. It means that companies that are of higher quality, higher ROE, will tend to do better than companies that are of lower ROE and need to borrow. Yeah, so that also relates to the strength of their balance sheet and the strength of their cash flows. So we prefer companies with better balance sheets, better cash flows, better ROEs. For us, that means defensive. And companies that have good cash flows ultimately can pay dividends. So the upside of owning these companies through a difficult time is that they'll still pay some form of dividends. Coincidentally, if you look at LQ45 dividend yields, that has gone up substantially in the last 12 months because of very large dividends paid by large caps like the banks, Mandiri, BRI, or even Astra and United Tractors. We think there is a chance that some of these dividends will stay high in 2024. So in the next 6 months or 9 months, you will see dividends again being paid, and that helps to anchor some equity returns. So equity side, we're defensive, preferring companies that meet those criteria. And obviously, there are certain sectors that map into these qualities. Quite simplistically put, I think a number of large banks will fit this criteria.